Many multifamily returns are not built on cash flow. They're built on a refinance that may or may not happen. And that is worth understanding before you commit capital. In a typical syndication model, the projected return to the LP is built from three layers: cash flow during the hold, potentially a refinance, and a sale in the end. The refinance, when it works, is often where the most attractive returns are generated. It returns capital to the LP, tax deferred. It can also reset the deal structure if the original pref has been satisfied. The problem is that the refinance is not a certainty, it is an assumption. A refinance depends on three things lining up at the same time. NOI growth has to be sufficient to support a new loan at the projected size. The lending environment has to support that loan amount at acceptable terms, and the appraised value has to come in at or above the underwriting projection. When any of those three factors breaks, the refinance does not happen on the original terms. Sometimes it may not happen at all. So what happens then? The capital that was supposed to be returned to LPs stays in the deal. The pref keeps accruing, sometimes at a different rate. The investor's IRR projection gets pushed out. And if the original loan is maturing, the sponsor may face refinancing into a higher rate environment with no return of capital event for the LPs, especially with a bridge loan. This is a pretty big risk that a lot of multifamily deals are facing right now, especially if refinance was assumed in year three. A lot of times LPs do not realize how much the projected return depends on that one single event. So the question worth asking is straightforward. What percent of the projected return depends on a refinance event? And if is there one at all in the projections? What are the underlying assumptions for that refinance, including NOI, cap rate, new loan terms, and what does the return look like if the refinance does not happen at all or the deal goes straight to sell in year five? A sponsor who stress tested the refinance can show you all of these scenarios. And a sponsor who did not will tell you the refinance is conservative and move on. A conservative refinance assumption today is one that for which you have run the sensitivity analysis on. Conviction without the sensitivity is just overconfidence. The refinance is often where the return lives or dies. If this was useful, subscribe and leave a comment. And if you are reviewing a deal and want a second set of eyes, send me a direct message.